So we're really excited to be able to present some of our findings and opinions on some of the big talking points in the offshore rig market today, which include things like this sort of move towards sustainable drilling solutions, potential rig owner consolidation, and also some of the new recovery that we're witnessing in the market and where we expect utilization to head in the next few years as well. So these are all quite forward-looking topics, and we really want today and for this presentation to focus on future trends rather than going over the difficulties of the last few years, which we believe has already been covered in quite a lot of detail. Right. So just before we jump into the main part, we just want to briefly introduce Esgian and what we do, because I know we are fairly new to quite a lot of people. So yeah, Esgian's a new company which came about out of a merger between Vaso Offshore and Greenpact, and it was created to provide insights and analytical tools to advance sustainability. And that's for different offshore industries as well. So we're still a small team of 20 colleagues, and we're located in Norway, the UK, and the US. In terms of products, I'm sure many of you are already familiar with Vaso Rig Analytics, which is a database that tracks all offshore rig activity, and that includes demand and forecasting of demand and utilization as well. And we also have an offshore rig valuation database, which gives values for over 700 rigs and is continuously updated as well. Now, we also recently launched Greenpact Rigs, which is a database of CO2 emission analysis of the entire offshore rig fleet. And actually, all the information that you'll see in the presentation today is taken from those products. We'll soon also be offering some more products outside of just the rig industry as well, and we'll be launching Greenpact Ships and Greenpact Wind. So there are two more emission analysis products, as well as offshore wind analytics, which tracks wind installation vessels, as well as wind farms themselves as well. Okay, so I thought we could start off by focusing in on sort of the elephant in the room just now, which is, of course, emissions. Reading energy news headlines these days, it's really difficult to kind of escape and get away from, all the news about energy companies' plans and targets to reach net zero, or how they are planning to react or are reacting to the intensifying energy transition. So in terms of offshore drilling rigs, how much CO2 emissions are we really talking about? Now, according to Greenpact Rigs, over the past year, the total offshore fleet of jackups, semi-subs and drill ships generated approximately 10.8 million tonnes of CO2. Now, that's equal to the same amount of CO2 emitted by around 3.5 million cars in North America during the same period. Now, the map on the right-hand side highlights with the darkest blue the countries that have the highest CO2 footprint from offshore drilling operations. So we're talking about China, Saudi, Norway, the US Gulf of Mexico, Brazil, Mexico, and India are the world's largest emitters of CO2 emissions from offshore drilling, which I suppose isn't really that much of a surprise, considering that those areas or countries are some of the most active in terms of offshore oil and gas activities. So in terms of rig type, jackups produced about 6.5 million tonnes of CO2 over the past 12 months, and floating rigs generated about 4.3 million tonnes. But just to emphasise that that's due to there being more shallow water units operating than their counterparts, and not just because jackups are bigger emitters or anything like that. So for contracts awarded up to early June 2021 alone, there will be 3.5 million tonnes of CO2 released in the atmosphere. Now, we're finding that currently the reporting of greenhouse gas emissions by drilling contractors is currently pretty patchy just now. But due to new EU legislation, European drilling contractors will actually have to start reporting on sustainability from 2023. And CO2 emissions are a likely parameter of that. And in terms of their international counterparts, there are also plans for more regulation. regarding reporting of sustainability. However, there really aren't any sort of set dates or targets in terms of that yet. Okay, so we now know that a lot of CO2 is being emitted through drilling, but what's being done about it? So over the past 2 or 3 years especially, there's been a growing trend of rig owners retrofitting their rigs with emission reducing or fuel saving technology or systems. And that's in a bid to help not just their clients, the oil and gas companies, lower their emissions, but also to help them meet their own sustainability targets as well. So this slide here highlights some of the drilling contractors that are putting in really the most investment in this side of things so far. So we're talking about Transocean, Maersk, COSL, Odfjell, Borr and Seadrill are 6 of the rig owners or managers that have been really the most active so far in upgrading their rigs, and also in focusing attentions on the importance and also the value in not just reducing emissions, but also other benefits for their clients as well, such as fuel and cost savings. So I won't talk through each driller and each technology because I know there's quite a bit on there, but just touch on a couple of those. So common system upgrades include things like hybrid power, DP closed bus operations, energy emissions efficiency software, selective catalytic reduction systems, and more recently we saw Seadrill announce that its West Saturn drill ship will be installed with a hydrogen and methanol injection system, and that's along with other upgrades as well. And that will be prior to commencing a long-term campaign offshore Brazil with Equinor. Now, the majority of these systems have only been used on rigs for a fairly short time and are still in their infancy. And therefore, results are really still coming in, on the reduction of CO2. But in terms of hybrid power and closed bus solutions, the targeted reductions are commonly around the 10 to 25% mark in terms of fuel and CO2 emissions. Now, you'll see that there's flags next to each of these drillers' names, and that actually represents countries where rigs with these solutions are currently or are planned to be deployed in the future. And as you can see, this is, it's by no means a global movement yet. There's still a fairly small amount of units with these sort of upgrades in place. But we do see that the North Sea is leading the way. And that's especially in Norway and the Netherlands, where there are either incentives or strict regulations that are driving demand for low emission rigs. However, I do think also it's important to note that the US Gulf of Mexico is also an area of growth, and that's due mostly to Transocean's rollout of its patented hybrid power systems on several of its drill ships working in the region. And also, in addition to that, the rig owner also has plans for such technologies to be implemented on 2 of its 20K new builds, its drill ships, sorry, that will also work in the same region from 2022 and 2023. Now, this is just a very quick slide highlighting that, again, that there are actually new builds being built with emissions in mind, and not all are just being retrofitted for that purpose. So I've mentioned Transocean's new builds, both of which have long-term campaigns lined up, and I think they're still subject to the clients taking FIDs on those developments, but both are also 2 of the most capable high specification drill ships in the market, or that will be in the market upon delivery. Then we also have the 2 Moss Maritime CS60 Eco Harsh Environment semi-subs, which were ordered by Awilco Drilling, and that was for the purpose of marketing those, in Norway, but which have now had their orders cancelled after being originally ordered for $425 million apiece. Now, both of these are very much designed with emphasis on sustainable drilling, as well as fuel and cost reductions for the client too. Now, Awilco and Keppel FELS are currently in ongoing arbitration surrounding the cancellations, but we expect these to eventually be sold to a company looking to invest and perhaps upgrade their own fleets with more sustainable assets and for target work in the North Sea, where these units are really most suited for work. Now, when construction is completed, these two units will boast some of the biggest claims in terms of reductions of up to 45% lower CO2 emissions in comparison to the tier one competitors in the Norwegian market. And we don't believe that there will be a large scale order for these sort of new builds. And that is mainly down to things like the high costs associated with building a new rig, also the lack of free cash, and also the continued oversupply situation. But we do expect to see more retrofits happen instead. And then just to touch on some of the benefits as well for drillers that we're seeing in addition to, of course, helping the environment and helping their clients reach their emissions goals. So we're finding that the majority of these upgraded units, they have, strong contract backlog, but they also have good prospects for follow-on work as well, as they have this sort of competitive edge. And there aren't many of these units around, so a few drillers have the monopoly on the offering. We're also seeing a premium on day rates being paid for these type of units as well, as emission reduction bonus, as well as emission reduction bonus schemes also being introduced by some operators such as Equinor as well. So although those upgrades can be very expensive, we believe these rig owners are seeing potential for making back that investment fairly quickly. Now, a lot of the rigs as well upgraded upgraded for work in Norway were partially funded by the Norwegian NOx Fund as well, which is a body that was set up to provide companies, including rig owners, grants for NOx reducing or environmentally friendly technology. And then also in our BASO rig values tool, we're also valuing many of these assets higher than some of their counterparts without that sort of technology or systems on board. And then, of course, there's also cost savings for the customer too. So as many of the emission reducing systems are based on fuel efficiency, that leads to cost savings through reducing fuel consumption for the rig operator. And again, this is just a very short slide to highlight that for some offshore drillers, it's not just rig upgrades that they're investing in to support the energy transition, and that some of them are actually going a little bit further. So we've seen some companies such as Odfjell, Maersk, and Stena investing in companies or projects or partnering with companies that are participating in alternate energies or offering different solutions. So for Odfjell, I'm sure most of you have seen the news that they have invested in ocean wind and hope to be able to connect their mobile offshore drilling units to offshore wind installations to power drilling campaigns in the future. Now, since they announced the initial partnership, the two have now combined to create Odfjell Ocean Wind, which plans to develop, own and operate a fleet of floating mobile offshore wind units with the primary purpose of supplying electricity to off-grid or microgrid customers. So meanwhile, Stena has also signed a strategic framework agreement with a company called DecarbonX for what they call decarbonisation exploration. Now, Stena says that it will utilise its rigs for geothermal energy, CO2 and other gas storage locations, to explore for geothermal energy, CO2 and other gas storage locations, which would initially be identified by DecarbonX. Then also you have Maersk as well, which is involved in various projects, one of which is the Danish project Greensand Carbon Capture and Storage Consortium. And they may also provide rigs for drilling wells for that project as well. And it also owns one of the first rigs that was powered from shore with the Maersk Invincible jackup, which was utilised for plugging wells on Aker BP's Norwegian Valhall field. And it also invested $1 million in a company developing a new technology called carbon negative energy as well. So, why are these drillers doing this? So basically by expanding and diversifying their offering and investing in new energies and technologies, they're they'll be able to move through the energy transition with more ease. And it makes good business sense to invest elsewhere as the energy transition speeds up. And it makes sense for their own sustainability goals and for their long-term business plans as well. Now, just to hand over to Hans Jakob, who's going to talk us through some of the things that we're seeing in terms of consolidation in the market.
Thank you for that. So starting off with what we've seen, we can observe on the M&A tree on the left-hand side that since 2014, there's been a decent amount of M&A activity. And this really took off in 2017, 2018, when a sense of optimism returned to the market. In total, we saw 7 transactions completed, resulting in 12 companies becoming 5, and also some spin-offs such as Paragon and Ara Drilling. But despite this, the offshore drilling market remains fairly fragmented. Today, there are approximately 750 rigs globally, distributed over more than 100 owners, while the top 14 largest rig owners control about 50%. The situation creates a very competitive market that dampens the upside cycles and limits the ability to mitigate the current oversupply of rigs. If you can move to the next slide, please. Currently, we can see that offshore drillers are at a turning point. For a long time, the offshore rig market has been suffering from low day rates, low utilization, and distressed asset prices, all of which just been worsened by the recent COVID-19 pandemic. And this have, of course, led to a lot of drillers enter Chapter 11 during 2020 and leading into 2021. But now, after tough negotiation with the creditors, offshore drillers are coming out of restructuring with clear balance sheets and into a market with a much stronger oil price. And not only this, we can see that asset values have followed the oil price. And today, Basel rig values estimate that the global rig fleet value is to be about $44 billion. As seen on the left-handed graph, we can see that the rig values have bottomed and begun to slightly improve, leading us to believe that the time for consolidation is now. And the first move has already been made by Noble, which acquired Pacific Drilling earlier this year. Next slide, please. So how much consolidation can we expect, or how much consolidation is enough? In a quite hypothetical scenario, we played with the idea of consolidations on a massive scale to create these so-called super drillers, as we can see on the M&A tree on the left-hand side. The idea is not to predict who will acquire whom, but rather we would like to see how a wave of consolidation could change up the market. We think that offshore drillers in the future will consolidate to become more area-focused, more asset-focused, and also become more competitive in the sustainable space. And the changes are quite clear. Now, the 52% of the global fleet is controlled by only 4 companies, while previously this percentage was controlled by 14 companies. And the top 10 companies now hold almost 2/3 of the global fleet. The result could lead to an offshore drillers becoming more capable to mitigate the oversupply, as you could have rig removals on a potential large scale, and also an increase in pricing power, where companies are better positioned during negotiations, especially for longer term work at day rates that match the capital invested. Next slide, please. I will now hand it over to Teresa, who will talk about market recovery and outlook.
Yeah, thanks for that, Hans. So before we touch upon some of the reasons behind the positivity that we are, seeing in the market just now, and also looking at our utilization forecasts, I want to bring it back again just quickly to the energy transition and its potential impact on the market. So a few weeks ago, we saw the IEA's report outlining a roadmap and recommendations for reaching the net zero by 2050. The organisation called for no new investment in new fossil fuel supply projects, including no new FIDs or exploration, and that's needed to meet that target. But in addition to that, We're seeing lots of news reports highlighting the growing pressure in oil and gas producing companies from governments and their own shareholders to reduce emissions and to do it quickly. Now, we do expect that over time, the global reliance on fossil fuels will decrease, but despite the IEA's recommendation, we believe that the weaning off of oil and gas will be a longer process. So we don't anticipate future rig demand to reach the all-time highs witnessed around 2012, 2013. However, we do expect a recovery over the coming years, and one which we believe has already begun. Just bringing us all back to the present day, there is, of course, this newfound optimism and recovery that's begun in the market, and there are really several reasons for this. The first is, of course, that we have a much stronger and more stable oil price, with Brent remaining over $50 per barrel since the start of this year. And more recently, it's been hovering around the $74, $75 per barrel mark, which is a high we really haven't seen for a few years now. So this, of course, means that offshore projects are once again becoming more economically viable, which brings us to the next reason for optimism, which is increased tendering and contract awards. So we've actually seen that rig contract backlog has finally started increasing after almost a year of losses. And since January 2021 until mid-June, there have been 162 contracts or extensions awarded, which total over 160 years of backlog added with a value of just under $6 billion. Now, average contract duration for 2021 so far is around about 377 days, which is an uptick against last year's 323 days. This year's average contract duration could rise further if we do see some of these longer term duration outstanding requirements awarded, which would bring it more in line with 2019's total, which was over 390 days on average. Now, we don't see that split across all of the rig types. So we'd say that in terms of duration, jackups are definitely leading the way, and semi-subs are by far out of the three showing the smallest number in terms of average. Now, also figure 9 also shows that total supply is decreasing due to higher numbers of rigs permanently leaving the fleet than new builds being delivered. Now, we do expect this trend to continue through 2021 and beyond, especially so if we do see more M&A transactions within the rig owner space as well. Now, in addition to these, there have been some slight signs of upward movement in terms of day rates as demand and competitive utilization rise faster in certain areas and certain segments of the market. In terms of the jackup segment, it's unsurprising that harsh environment units are seeing some of the larger increases lately. And not just for units in the North Sea, but also for those fixed in other areas like Australia as well. However, we do find that the premium segment and the vintage and standard jackup segment are still flat in terms of rates, as low utilization and oversupply both persist. And we believe until more is done on the supply side, that rates will continue to be restrained in those segments. Meanwhile, though, there have been some higher than anticipated day rates fixed for awards in the 6th and 7th generation drillship segments, and also in the benign semi-sub segments as well. These higher rates are not really being seen across the board, but are either for units in areas where supply is starting to tighten, like the US Gulf of Mexico, or for rigs that have higher specifications or certain system capabilities like MPD. But certainly some of these rates are helping again with that sense of optimism, as these fixtures are much higher than those we were seeing just last year, really. Now, moving on just to take a look at the global jackup market. So the competitive jackup segment is expected to reach the 74% mark by the end of June, and we expect that figure to continue rising to the 84 to 85% mark in the next 18 months. So by the end of 2022, start of 2023. We have seen and will continue to see demand recovery in the jackup segment, which continues to be driven by national oil companies in areas such as the Middle East, India, Mexico, and the Far East, as those companies and countries continue to focus efforts on increasing and maintaining their domestic supply. On a smaller scale, but still very important, we expect the North Sea, Southeast Asia, and West Africa to provide additional demand, but with more of that coming from independents. Now, as mentioned earlier, we do anticipate additional demand. We do anticipate additional scrapping of older tonnage in the shallow water rig segment over the coming years. And we will see the majority of near-term attrition in the uncompetitive fleet, which means units that have been cold stacked and unemployed for some time, nor marketed for work, which means we don't believe competitive supply will shrink much further in the near term, which of course will continue to hamper day rates for the non-harsh environment units. But we do actually expect that a number of new builds will be delivered over the period as operators look to bring in some newer tonnage to replace aging assets for the operations. Now, it should be noted that we are also seeing more tenders, which are specifying rigs that are under 10 years of age. So on figure 13, we're showing a sort of what-if hypothetical scenario in which all of the rigs over 10 years old are removed from the competitive fleet. Now that, as you can see, results in a pretty stark undersupply of rigs in the market, even without an increase in anticipated demand. Although this is by no means a near-term prediction, we believe that as more units age, they will become commercially and technically uncompetitive, and this could have a major impact on the market. Now, here we have a similar scenario, but for the drillship and semi-sub segments. So by the end of June, we expect that floating rig demand will have recovered to around 64%. And again, this is partially down to increasing demand, but we believe that the lower competitive supply, following a lot of cold stacking and scrapping over the last year, has done a lot to kickstart utilization increases, which is set to continue moving upward in the next 18 months, though not to the same extent as the jackup segment. The majority of demand is coming out of South America, where Petrobras is finally beginning to increase its rig count after many years of decreases. Plus, other independent operators have or are planning their own development or exploration campaigns off Brazil as well. Then, of course, we're also seeing increasing floaters moving into areas like Guyana, Suriname, and Trinidad. Then, of course, outside of South America, most demand will be led by independent operators in areas such as the North Sea, where we expect to see the majority of demand for harsh environment units, as well as the US Gulf of Mexico, West Africa, the Far East, and Southeast Asia. Now, similar to the shallow water side of the market, we believe that there is further attrition planned and also needed in the floating rig segment in the next few years, which of course may be amplified by, again, further consolidation within the rig owner segment. However, similarly, the majority of these will likely be removed, the near term I'm talking about here, will likely be removed from the cold stack fleet. And therefore, competitive supply will likely plateau as we see some of the planned new builds coming into the market during the forecast period. Now, once again, if we were to consider any of the floating fleet that's over 10 years old as uncompetitive, this again would drive utilization much higher, and we're seeing that undersupply again. However, this would be a much bigger issue in the competitive semi-sub fleet, where the average age of units is 19 years old in comparison to the drillship fleet, which is just 9 years old. And just handing back over to Hans Jakob for some conclusions.
Yes, so moving into the conclusion, we can see that the offshore drilling market seems to be heading into a recovery after a long and gloomy period. The drilling contractors are coming out of Chapter 11 in a market that sees a higher oil price, higher utilization, and higher day rates, and we expect further consolidation to happening this year. The next big challenge for the industry is how to respond to the energy transition. Offshore drillers are emitting tons of greenhouse gases and will experience continued pressure not only from regulatory bodies, but also from oil and gas companies that look to lower their own emissions. And with the International Energy Agency's recent report that argues that investors should not fund new oil, gas, and coal projects if we want the world to reach net zero by mid-century, the future of oil and gas sounds uncertain. But most oil and gas companies won't divest all their assets as hydrocarbons continues to play an important role in the energy transition. Rather, companies will diversify their energy portfolio and look to continue drilling, but in more sustainable ways. Therefore, rather than being a problem, the energy transition could be an opportunity for offshore drillers to gain a competitive edge. And now I'd like to hand it back to Paul for some Q&A.